Hey, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, make your own financial conclusions, and make your own financial decisions. Today is Sunday, January 29th, 2023, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and we had a couple of schedule conflicts last week, so we're actually recording this on Sunday, and it is a big earnings week, and I want to lay out a potential 1% earnings trade in this week's episode. But before we get to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear the type of content you want to hear about. Also, you can go to thetagang.com/sprocket888, and you can see each and every one of my trades, the good, the bad, and the ugly. Last, this episode is also released as a podcast, so wherever you get your podcast, look up Blockhead Traders. If you can't find it, let us know, and we will get it there. So moving along to this week's content, huge earnings week, and it's been a little while since I had a 1% trade. Viper and I had a couple of schedule conflicts last week, so I'm going to go ahead and do this show solo, and I wanted to take an opportunity to actually lay out a potential 1% earnings trade. We haven't done an earnings trade as part of the 1% challenge, so that will be fun. Additionally, the way this is going to play out is I don't actually have my strikes chosen yet, but this trade will go live this week during the market, and we'll talk about that, and it will be done before next week's episode. So if you're actually listening to this when it's released or at the front half of the week, you likely will hear this information before the trade actually can open up, and then you can follow up with us next week and see how it goes. If you don't, and this is already after the fact, don't worry about it. The mechanics here still hold true, and we're going to talk about the principle and the mechanics behind what I like to do in an earnings trade by selling premium. So let's hop to the interesting stuff. And I actually documented a lot of this mechanics here and my thinking as part of one of my recent blog posts on blockheadtraders.com. So I'll put a link in the description below to that. You'll be able to kind of read through the thought process that I'm actually going to lay out here in this episode visually and verbally, but you can kind of get it also in reading content there as well. And where we're going to start off is really about screening for the trade. And before we even get into that, what I want to talk about is when earnings come around, there's all kinds of different ways to play earnings. Some people like to sell shares. Some people like to buy shares. Some people like to trade options. They like to buy options. Some people like to sell them. I mean, there's just all kinds of different ways that you can trade a company's earnings announcement. And an earnings announcement is what Viper and I would call a binary event. It is some event that is known to happen, and you know exactly when it's going to happen. There's a lot of uncertainty around it, and binary events, as we always say, can be an accelerant for price. So a lot of times you can get explosive movement up, explosive movement down, and playing earnings is kind of trading the excitement around that. And I do want to caution a little bit here because we are going to be doing what I call selling volatility. And a lot of times this is a high probability trade in the seller's favor, except around earnings. You can look at the statistics around it and you can say, oh, it should be really much in my favor. My personal experience when trading earnings in this fashion is much closer to a 50-50 coin flip than actually putting a large majority of the probability in your favor. It still is in your favor. Statistically, I think it should come out around 67% in your favor to win. My anecdotal experience or kind of the logging that I've done from these earnings trades usually put my win rate more in the realm of 58% or 55%, somewhere in there, where it's above 50%, but it's not that far. So take that into account when you take in your own risk tolerance and what you're comfortable with, because this is not quite as surefire of a way to get a win as some of the other selling premium strategies that are not centered around binary events. So, what do I mean by selling volatility? So, this is very similar to kind of shorting a stock. When you short a stock, you basically borrow the shares from someone who has them, your broker. You will quickly turn around and you sell them on the market for some price because you believe the stock price is going to go down. You wait for that price to kind of go down, then you buy the shares back at that lower price and you return those shares back to your broker from which you borrowed them from. And the profit that you make is that delta between when you sold it and what you had to buy it back for. And you were counting on the stock price to go down, and that is how you profit when you short a stock. So, shorting volatility is very similar to that. We're basically hoping that volatility is going to go down in a particular stock. And the slight edge here, which I guess I wouldn't really call it an edge, but the mechanic behind it, it's not an edge because everybody knows this. As you approach an earnings announcement, there is a lot of volatility in stock inherently because there's a lot of unknown about what will be said at that earnings announcement. Did the company miss their targets? Did they hit their targets? What are they guiding next quarter? There's a lot of unknown. And anytime a stock price has a lot of unknown to it, volatility will kind of increase. And so when we are looking to sell volatility on earnings announcement, one of the prerequisites or the screeners that I put forth is I want to try to find the companies that have earnings announcements coming up where their volatility is already elevated to the point that is much higher than their historical average. And it's really a play on a mean reversion. So the thinking and the mechanics behind this is, okay, everybody doesn't know what's happening leading up to earnings. So volatility is pumped. And once those earnings announcements are out, everybody knows what they are. Everybody can then start trading. Volatility just absolutely crushes after that earnings announcement. And in the options world, a huge component of the price of the option is the volatility in what you are trading. And that is because options are very, very much like an insurance policy. And when you don't know what is going to happen, that insurance premium is going to be very high. Once kind of the stuff is out there, it's known, you have a known quantity, there's not so much uncertainty, so volatility dramatically comes down because there's not, it's really known what you're insuring against. There's really not that unknown factor anymore. And that's really what we're trying to look for in an earnings trade around shorting volatility. We want to find that abnormally elevated volatility. We want to sell that volatility before the earnings announcement. Immediately following the early earnings announcement, when that volatility is contracting and crushing, we want to buy it back because it's going to be cheaper. The option will dramatically drop in price. We can buy it back, close our position out. Just like shorting a stock, we are going to make the profit of that distance between what we sold it for and what we can buy it back for. So how do we screen for these options? Well, let's go ahead. I'm going to flip over to my Thinkorswim platform, and I'm going to call out here my earnings screener. And I'm going to talk about some of these parameters that I'm putting into this earnings screener, just because a lot of them you can tweak yourself. This is in my TD Ameritrade account. I use Thinkorswim. The similar variables and screening mechanisms are available in all the major brokers, all the different stock trading. There's no strange or archaic methodology here. These are all very, very basic fundamental measurements in the technicalities of the options and the underlying stock. So what I start out with here is stock close and a min and a max. Now, in this particular trade, I'm going to be doing a vertical. This basically is going to define my risk. It's the only way I'm going to be able to fit in that $100 trade profile for the 1% challenge. If I was not doing a vertical and I was trading the shares naked as the options go, I might want to define a max price for the stock, because the higher that stock price is, the more buying power it's going to need from me, and it could be too big for my particular portfolio. In this case, because I'm going to define that risk by a vertical, I've actually removed the maximum stock price. Now, I still have a minimum of $10 because I've found in my own experience, you really don't want to mess around with earnings or options chains. Once you're below like $15, $20, somewhere in there, the premium is just not worth it to me. You can tweak this yourself and you can find out what your threshold is and the plays that kind of pop up. I put $10 here just in case there's something real interesting that's cheap that might pop up. But most of the time, I'm going to be looking for some sort of underlying that's trading above, $40, $50 up to a few $100 is typically what I'm going to end up looking at. The next parameter here is the volatility index. This is the spot volatility price. This is not the historical IV percentile. This is what is the immediate volatility in the underlying today. And you will find that certain stocks have lower volatility just inherently, but they can still be elevated overall. And so there's a balance there. What I mean by that is maybe a commodity or a financial. Let's go with the financials. A lot of times their volatility is much, much lower because they're kind of a known entity. They don't have as much growth. There's not a lot of ambiguous investments that they're going to go after. It's kind of, we know what we get from banks. Where a tech stock or something like that has a lot more volatility inherently because they're focused on a lot more growth. They're taking a lot more speculative strategies, things like that. So there's not really a good absolute number for this spot volatility that's good or bad. What I have found over time is I do not like a lot of premium where that spot volatility is under 30%. So that's just a threshold that I put out there is saying I want that volatility to be above 30% spot price. This is not the ranking. We'll get to that in a minute. It just means, you could have a financial bank, which might be in the 90th percentile of volatility, but their spot price might be, 40%. Whereas a tech stock or a pharmaceutical might be also in the 90th percentile and their spot volatility might be 300% or 400%. So, this is one of these parameters that you'll end up tweaking to your own risk profile over time as you kind of, run through various numbers and what type of things show up on the screener, something to play around with. The next parameter is really the most important one or when I go to look at this short volatility, and this is the IV percentile. Now, right now I have this basically wide open, 0 to 200%. This value will pretty much always be between 0 and 100 because what this value represents is over the past 52 week trading period, daily is typically how I look at it, how many times, what percentage of the time has the volatility been higher or lower? So, for example, a stock that has a 90% IV percentile, basically that means that 90% of the time volatility has been lower than where it is right now. That is a very good indication that volatility is very much overstated or elevated. I like this to be high. Most of the time, I'm only going to touch things that are over 40 to 45% IV rank, and I really want to see something over 50% most of the time. And that is just a good indication that when we're oscillating with volatility, because volatility is essentially an oscillator from, or IV percentile is an oscillator, not necessarily volatility. It's going between, the lowest it's ever been to the highest it's ever been and some percentage in between. So I'm looking for shorting volatility, so I want it to be as extended as possible because I am banking on that mean reversion of volatility coming back down. The next thing that I'm screening for is, I only want to look at companies that have earnings coming up. Because an earnings trade is around that binary event, basically you want to know what is coming up this trading week. Maybe you'll want to look, if it's Thursday or Friday, you're going to be saying, what's next week? And so you might kind of fiddle around with this number, but this is a Sunday. So I'm basically saying, show me all the companies that have an earnings announcement anytime in the next 5 bars. And I have the bars here set to D, which means daily. So this is basically saying, find me anything that has an earnings announcement in the next 5 days. Now, the last metric that I have, there's actually 2 more, but this one is a duplicate of the above one because sometimes I like to try to narrow when the earnings are. But I opened this up just for 5 days. But average volume. So in order to take these trades, we're going to want to enter them and we want to get out of them after the earnings announcement. So we want them to be liquid. We don't want to deal with price slippage. We don't want to deal with the risk of not getting our orders filled. So we want things that are very, very liquid. Now, this is another thing where you can kind of tweak around what your tolerance is. I typically like to see 1 million shares traded on average each day over the most recent 5-day period. This kind of helps smooth out, stocks that might have abnormal high volume one day, but low the next. It kind of smooths it out. And you're really looking for those type of stocks that are trading hands very frequently in the trading day. You can increase this more, you can lower it if your is not returning enough results. And because you're really going to check for that absolute liquidity once you identify a particular option or underlying that you want to play the earnings of. We're really going to define that liquidity by the bid-ask spread of the option chain. But I don't want to make this list so noisy, and so a good rough cut of liquidity is basically just the number of volume of shares trading hands over some period of time most recently. So once I run that scan, which I have run here, I sort the list by that IV percentile. And keeping in mind that the higher the IV percentile, the more extended the volatility is compared to the historical values. And so my next kind of cut is, okay, what of these stocks do I recognize? Which ones look interesting based on the IV percentile? Again, I'm really looking for something above 45, 50% IV percentile. I'm looking for high volume. And so a couple things jump out at me. We got Team, that definitely jumps out, which is Atlassian. Snap jumps out, and Amazon. So all three of these I am familiar with. All three of them have pretty decent volume. Snap, I'm a little apprehensive to trade simply on this share price of $10.91. Not going to squeak out a lot of premium from that. And because I'm going to be doing verticals, you're more than welcome to throw these things in, see how it shakes out for you. But for the purposes of this, I'm going to go with Amazon. I actually would love to play Team. Unfortunately, when I looked at that option chain, the smallest vertical I can get is a $2.50 vertical, which basically means my max risk will be $250, and that is in violation of that $100 limit of the 1% challenge. So I might put a trade on Team, but it's not going to be the 1% challenge trade because that is over that budget of $100 per trade. Amazon actually has their strikes $1 apart, so I can actually enter an Amazon trade for max risk of $100, fitting that 1% trade limitation that I've kind of imposed. So now that we've got Amazon, let's transition over to the option chain, because the first thing I'm going to do is confirm that this is liquid and that is going to kind of fit into my risk profile that I'm after. So as we move over to the option chain here, you're going to see on the screen several different dates. And what this is basically the expiration of the option. On the previous screen, I will go back very briefly to kind of call out that you can click to find out when is Amazon's actual earnings announcement. And looking at this, the earnings announcement is actually February 2nd, 2023. So they are after the bell on February 2nd, 2023. That is this coming Thursday. I guess this doesn't actually show up in my screen grab because it's cut off below there, but that tells me the date of the option or date of earnings, which is when I'm looking at the option chain, I am going to want to pay attention to the options expiring on the Friday of the week of earnings. And so that is this top one of 3rd February, 2023. That is this Friday. And if you wanted to see what I'm talking about, where there's a lot of uncertainty, these percentages all the way over here on the right is the volatility in that specific option chain or strike price. There's many different ways to look at volatility. When I did the screener just above, that is the volatility in the stock price. These numbers are the volatility in the options contracts themselves. And you can see that the ones that are expiring this week have a 90% volatility, spot volatility. This is not rank, this is spot volatility. And if you kind of come out to, just the ones that expire monthly, that drops off to 60%. Reason being that uncertainty around earnings. Nobody knows what's going to happen at earnings. The price is going to move after earnings announcement. That's happening this week. Therefore, the most insurance premium is going to be around options that are closest to that binary event. So these is the option chain that I want to trade. So what I'll do is I'll open up this option chain to take a look at it. And when this pops up, you're going to get all these various strike prices and the bid and the ask for each of these prices. And what I'm looking at here is to make sure as I flip through this that there is good small distance between the bid and the ask. That basically means we have good liquidity in the option chain. And you can see, we're talking not far off, 6 cents here at the 98 strike. 6 cents here at the 94 strike. And I pay attention mostly at the money. So right now, this particular one it closed on Friday around 102.24. So right here at the money, we're talking 10 cents, 420 to 410 as your bid ask spread. So absolutely liquidity is very, very good here. This meets my criteria. So check, check, check. We got elevated volatility. We got good liquidity. Earnings are this week. And so this is the play that I am going to put on. So the next thing to look at is say basically, okay, now that I know this is the thing, what strikes do I pick? Now, if I go back to the earnings statement, we don't know if Amazon is going to go up, down. We don't know if they're going to beat, miss. What are they going to guide? The up and down movement actually doesn't always correlate to beating or missing expectations. It really, really, really is a flip of a coin. There are countless times when a particular stock beat expectations, but the stock price crashed. Why? Maybe they said something about guidance. Maybe there's something in the earnings call that investors didn't like. Who knows? You know what? I'm not going to try to predict that. I don't want to get in there. I just want to play the statistics, which means because we don't know, all we know is that price is going to likely move a good bit after the earnings announcement. We're going to try to capture both directions of risk. We're going to sell premium against the stock price rallying, and we're going to sell premium against the stock price dropping, which means it will turn into what is known as a strangle. Now, a strangle is selling options at two different strikes. You're going to sell a call and you're going to sell a put. Now, a strangle is an unprotected option trade. We are not going to do that around earnings. When you have an unprotected options trade, you basically have unlimited loss potential. And we want to clearly define our risk to the upside, our risk to the downside. We want to know what's our max profit, what's our max loss. We want to set all that out there on paper before we enter the trade. And the way that you do that is you sell that strangle, but at the same time, you're also going to buy a strangle a little bit farther out. What that effectively will turn into is selling two option verticals. And I'll show you this. And we're going to do that both on the top side and the bottom side. So where do we pick that? There's different approaches that you can take. You can try to analyze the chart from a price action and say, here are the levels that I think Amazon could kind of go to before there's some type of test. The test could mean rejection. The test could mean hesitation, some sort of reaction from the trade at those levels. Those levels could be really close to where the stock price is. They could be farther away. That is one approach that you could take. The approach that I typically take when trading earnings is a statistical approach. And what I do is I say, let me go look at the expected move. What is the expected move, which is typically a one standard deviation move from where price is. And let me put a strike one standard deviation above where the stock is today. And let me put one at one standard deviation below where it's at. This works out to be around a 16 delta strike. That's what I'm going to show you here in this option chain where you can identify those strikes. So we're going to start looking at the trade at a 16 Delta Iron Condor. I just threw another term out there. The other term I was referencing was strangle. When you put protection legs on your strangle, you create what's known as an iron condor. And I'll show you what that looks like in a P&L, and that's really where it kind of gets its name from. So the first thing we're going to do is we're going to look at the option chain, and we're going to try to identify where is the 16 delta put. So calls are on the left, puts are on the right. So you can define what columns you want to display. I have delta called out right here. And so I'm going to look for a 16 delta. We got 11, 13, 15, 17, 20, 23, no 16. So I'm going to say, okay, what's the closest to 16 that I can get? Probably this 17. So what I will do is I will enter a sell for that 17. Now, I also want protection, so I'm going to go out one strike to the 92, and I'm going to buy protection at the 92. This has effectively created a option spread. And let's just look at this because this is only one half of the trade, but let's take a look visually what this one half of the trade actually looks like. So what you'll see here is this P&L chart, and I am collecting $18 because there is a maximum movement of $1 before my protection kicks in. My max profit is $18 and my max loss is 82. However, I basically have, if I readjust this slide here to my strike of $93, let me just go ahead and put it right at that strike, 93. I have a 92% chance of being in the money at expiration. So you might think, oh my gosh, why would you take this trade? Because you're only picking up $18, but you could be risking up to $82. And I would tell you that, oh, well, statistically, this is calling out potentially a 92% chance of winning. This 8.28% up here in the upper left corner basically says there is an 8.28% chance that the price of the underlying will be below this $93 at the date of expiration, which is this Friday, February 3rd. So in order to play the top side, to basically say, I don't believe it's going to go above a particular amount, because what we're doing is we want to sell volatility both on the bottom side and the top side, and expect that volatility to contract. So we're going to go back to the option chain, and we're going to scroll down, and we're going to look at the call side again, looking at the column of delta, and we're going to look for that 16 delta. Again, we don't have a 16 delta, we have a 17 delta. So let's go ahead and add sale there of the 17 delta. Let's come out one strike to this 114. Let's go ahead and buy that protection leg. Now, you can see down here what we've got is we've got a 31-cent credit that we are going to collect from this. So let's go back to that picture of that P&L chart. And now look at what we've got. We've got, looks like these wings. This is where the term iron condor comes from. It's these wings. You got this defined range saying I'm going to be above 93 and we're going to be below 113 strike. So if I go ahead and I take the top side strike and I turn it to 113, just to see where that slice comes from, you can now see that in the middle, I've got a 6% chance that Amazon is going to be above 113 and 8% chance it's going to be below, which basically leaves me here in the middle an 85% chance that we are going to be somewhere between those two strikes. So this has an 85% chance of profiting. The other aspect of this to keep in mind is we are basically risking $100 to make $30. And if you looked at that on a return basis, that is a 31% return on that $100. And that is you have a 85% chance of getting a 30% return. Now, let me remind you back what I said in the beginning, that even though statistically that is what this looks like, my personal experience shows that crazy things can happen around earnings, and my actual earnings trading win percentage was a good bit lower than the statistical numbers. For other premium selling, these statistical numbers play out almost exactly to what they predict if given enough chances to populate the statistical distribution so that it is a representative sample set. So when do I put this trade on? Do I put this trade on Monday morning? No, I will not put this trade on Monday morning. The reason being because this price movement is still going to shift a good bit through the week. It never really is static. And when you're playing earnings, you want to try to put the trade on at the peak of volatility or the closest that you can to that point of uncertainty. Because you can get drift going into the earnings, and maybe this thing rallies and rallies and rallies, and all of a sudden, just before earnings, maybe it's sitting at $110 a share, and the expected move might be, say, $7. Now, okay, you got pretty good buffer to the downside, but if this thing goes $7 to the upside, you don't have a lot of protection there, and you might get breached. So selling this Iron Condor early is not something I do when trading earnings. You want to put it out almost as close as you can before earnings, so you really got those wings centered up for the price movement. No matter if we're going up or down, you want to start as centered as you can going into earnings. Now, if you have a thesis and you're like, oh no, we're definitely going up or something like that, you can tweak these strikes. You can tweak this, to fit your theory and your thesis. In this case, I want to center them up. So these earnings, remember I said, are after the bell on Thursday, February 2nd. So that means that I'm going to put this trade on that Thursday sometime after lunch. I'll probably look at what the option chain looks like. I might look at my lunch break and set my strikes at that time. So am I going to use 93 and 92, 113 and 114? Probably not, because chances are we're not going to be sitting at $102 on Amazon. So I will follow that same methodology that I just walked you through, looking for that 16 delta strike, wherever those 16 delta strikes are just before earnings. And I will sell the strike closest to 16. I will step $1 out and buy protection $1 farther away. On the put side, I will then flip to the call side. I will then go down and look for that 16 delta strike. I will sell that 16. I will step out one strike away from that and buy that protection. That will give me my max risk of $100. Hopefully, we'll still be in this $30 credit range. Could be a little less because Thursday is just one day before the option expiration. And so I might fiddle with those numbers a little bit, maybe stepping up to a 20 delta, messing around to try to get a decent risk reward premium. A lot of times I will risk two to make one. So I like to see, around a 30 to 35% return on that $100. So I'm going to want that credit that I'm collecting to be in this range of, 30 to 35 cents. And this is the premise of an earnings trade. Really can be done with any company. Any underlying earnings are 4 times a year. They come in big clumps. You can look, each week earnings season usually lasts, 2 or 3 weeks of very heavy announcements. You got a couple leading in, a couple trailing over that. So if you find that some of the excitement from earnings trades are things you like, you basically have 4 opportunities for about a 2 to 3 week period to look for earnings trades. The important part is if you're trading those earnings as short volatility, like I described here in this episode, you're really going to want to look for those elevated premiums. And my closing strategy here is basically to close out as soon as I get 50% of that profit back. I don't typically take this into expiration. That volatility is going to start to contract within the first hour of market open. And so a lot of times I'll look to close it out as soon as that volatility really contracts. I can lock in my green profit and I'll rinse and repeat and go after another one. You want to be a little bit careful, when you're deciding to close out, because you can get some pretty big swings. And it's entirely possible that the movement will exceed the volatility crush that you get. and there's really not much you can do about it. So you got to be, good going in to say, yep, I'm okay with this risk reward. I'm going to exit as soon as I can grab some green. That a lot of times will be within the first hour or two of trading. You can set up your closure order ahead of time to say, hey, buy this thing back at, 10 cents, 5 cents, whatever that number is. It'll close it out when it gets to that point. If it moves too far, well, that's why you define the risk. So, we'll see how this goes. You'll have the opportunity to kind of look at different earnings trades this week, set things up the way that you feel is comfortable for your risk reward profile. I will end up recording on my 1% trade what strikes I ended up taking with Amazon going into earnings. And we will review them next week in the episode because the trade will be done. Because I basically remember I'm trading the options that are going to expire this Friday. So whether or not the earnings trade is a winner or a loser, I will absolutely know by Friday because the options will be expired and I will have either exited early or exited for profit or been beaten out. I also expect a lot of price movement leading up to that Thursday earnings announcement because this week is also Fed week, where they're going to talk about interest rates and whether or not they're going to hike interest rates again. Most of the market, I believe, is expecting a 25 basis point hike from the Feds. Depending on what that is and depending on the commentary around it, who knows where stocks could be on Thursday as that Fed meeting is going to come out on Wednesday. And so that's just another reason that says, hold off, wait for that moment before earnings to center up the trade, put the trade on. Your trade is that one binary event. You're going to see a ton of movement after hours. Sometimes after hours, you see things completely blow through your strikes. The market opens the next day and the price retraces back into that Iron Condor. So really anything can happen. It's very exciting to watch. It can also be very nervous. So if you've never done it before, I highly recommend that you do this in your paper trading account that we've talked about before, just so you can see the mechanics on what it's like, what you see, how it moves, how do those Greeks and how does a premium shift depending on whether we're going up or down. Look at that volatility number. How much does that change over just before versus the day after? And as the trading day progresses, where's that volatility number at and how does it react? This will all be a very good learning experience for you guys. So hopefully you'll have the opportunity to check it out. If you missed this one and you happen to hear this episode later, the same mechanics can be done for any underlying. And we're basically just at the beginning of earnings season here for Q1 of 2023. So there will be multiple more opportunities to put earnings trades on if you missed this particular one on Amazon. Or maybe you don't care to play Amazon or trade Amazon and you want to look and identify something else. The same principles and the same mechanics will apply no matter what you end up picking. So good luck out there this week. Hope you have some fun. Like I said, it's going to be a very exciting week with the Fed minutes coming out. Lots and lots of big tech companies reporting earnings. Meta, Snap, Amazon, Google is also this week. So should be lots of movement and price action. We'll see where things shake out. We'll see how this trade pans out. And remember, think outside the block.